I've been getting a lot of questions about order flow, and Mike, is there a way that order flow could have helped us play this bounce here or even have a heads up we were likely going to break that former support level? Well, in this video, I'm going to show you guys how we can use order flow footprint charts to know when to buy the bounce and when to look for a key level to break. So before we actually go ahead and look at a footprint chart, the one thing we want to do first is we want to identify a key level in the market. Order flow is going to help us determine if that is going to be a key turning point or if we're likely going to go ahead and break out or break down through that level. So in this example, I'm going to use this volume profile chart and I'm going to really focus on this minus development area. Now, one thing I want you guys to think about is as we're coming up towards this level, when we actually get this break, we do not see anything below this white line. So the profile is just going to look like this part of the profile right up in this area. We don't get the remainder of the profile until after the break. Now, if you're wondering what is the volume profile, the further the profile protrudes out to the right, the more volume that was traded at that specific price point. So it's no wonder that the profile sticks out a lot more where we had a lot of this consolidation in the market. Why is that important? Because where the profile has high volume signifies where both buyers and sellers perceive there to be fair value in the market. So as a counter trend trader or a trader looking for a bounce, we want to play the edges. And that's why I highlighted this area on the chart right here in the ballpark of 24,975. Well, if we look left, we can see it was prior support here. We almost made it right there. So it looks like a key opportunity to potentially look for a bounce. And after I show you the criteria for the bounce, we're also then going to look and see, did order flow give us a heads up? That level was likely going to break, and we could have also played the breakdown from that level. Now, before we go too deep into this video, I want you guys to know the order flow indicator that I'm using for the footprint charts is the impact order flow indicator. If you want to check out the one I use, go to the link in the description box down below, affordable indicators. At checkout, use code Mike. However, if you have some other charting platform that has the footprint chart, you'll be absolutely fine and you'll be able to follow along just fine. Now, this white line right here is this same horizontal line within NinjaTrader. I have global objects turned on. So if I draw a line in this chart, it will then also transfer it right over here. Now, I want you guys to pay attention to something very close. If you were first looking to play that first breakout, I want you guys to pay attention to something on these two candles. As the market came down, look at these highlighted cells. These are going to be imbalances in the market. And when we get stacked imbalances, meaning 3 or more consecutive, this is going to be very, very important. Right here, we have 1, 2, and 3. And then the very next candle even, we have 3 on that candle as well. Now, one of the techniques I like to use, and I talk about this all the time on the live stream. If you guys want to follow me along on the live streams, I'll leave a link to the main channel in the pinned comment section. But right here, as soon as that next candle went below those stacked imbalances and got back above it, that was a big heads up because the sellers that were selling into weakness are now going to be trapped. And guess what? Those sellers, how do they exit their short position? They then have to become a buyer in the market. And then look, we're able to get back above the line and the market goes ahead and continues on up higher. What I really like about this order flow tool as well, it'll also map out other stacked imbalances. So for instance, we had these stacked imbalances right here. Well, guess what? Once we broke in, we start working our way back up. This is going to provide a very good target location in the future. And look, we came right up towards those levels and we were able to come back and re-auction that previous stacked and balanced zone. So as we're looking at, should we play the break or should we not? You could have been trapped into initially playing the break when you started to see these stacked imbalances here. And as soon as we started to break below it, you said, uh-oh, watch out, we're likely going to go lower. So if you did take a short position, once you started seeing the stacked imbalances below the candle, it would have been a clear heads up that either 1, exit the trade, or 2, go ahead and move your stop loss at minimum to break even. Now, in that event, well, guess what? You could have took a shot playing the sell side and then being able to recognize with the order flow that we were likely going to bounce. You could have then reversed the position. So you could have made a quick little scalp on the way down and then played for the move all the way back up. So as we look right here, that's the wick. And then look, we ran right back up before ultimately coming right back down. Now let's look at this, right? The more times a market's going to go ahead and hit on support, the more likely that level is going to give way because there's only going to be so many buyers at a particular level. So once all the sellers keep attacking, eventually that level will give way. And that brings us to the second scenario right over here. On this 30-minute candle that plots from 9:30 till 10 o'clock, this is the candle that actually breaks that swing point. Now let's look and see if there's any differences as we come back down towards that swing point. All right, so now I went back in that time period and notice this is after 9:30 in the morning, which coincides with that 30-minute nasty down candle. This white line is the same white line. Now I want you guys to pay attention. When we initially broke, did we have any clues to go short? Did we see any major sell imbalances we were staying below? The simple answer is no. Then when we get down here, do we get any stacked imbalances on this candle? No. But then look what we have right down here. We get some stacked imbalances. The market bounces back up. So initially, we may have been thinking, we're going to bounce again, which in this case, that still would have been a pretty good bounce. From the top of these stacked imbalances all the way up to here, on the NASDAQ, that would have been good for 20 points. That is a very fantastic move. But then look, as we start to come back down, and we're going to come back down and attack this level, I want you guys to pay very close attention. There's multiple clues before we actually break that level. If you look right here on this big up candle we had off the low, well, if we had the stacked imbalances at the low, what about these green stacked imbalances right over here on the chart where you see it's a brighter colored green with a dot right there? Those are also stacked imbalances. So as the market was able to push above that level, once we got back down below that level, that was a warning sign that there could be weakness in the market. And what I really like about this is if you would have shorted the market right below those stacked imbalances, you could have either put a stop loss right above that candle, which would have been about a 2.5 point stop loss, or you could have put it above the candle that made the high, which still would have only been roughly a 4.5 point stop. And on the NASDAQ, that's a very, very tight stop loss. Now notice, even if from that point, we only made it back down towards potential breakout point, notice from there, that is a 9 3/4 point potential move. So you can see, even if you use the worst case scenario stop loss, you would still have more than a 2-to-1 reward to risk ratio on this trade. However, notice what else we get. We also get some stacked imbalances here. And you might have said, let me go ahead and flip this for the move back up. And if you did, if you got scared out, well, guess what? Your entry would have been right here. Your target would have been right back up here at these stacked imbalances, which is exactly where the market turned. But then once we started coming back down again, getting below these stacked imbalances, well, guess what? Then we could have looked to short the market again. And then let's just play this out a little bit. If you shorted that break right there, let's look and see when the order flow says, watch out, there could be trouble. We had some stacked imbalances here. The next candle did get up. So maybe you end up getting out and down here. That would have been good for about 14 and 1/4 points. Now, if we zoom back up, if you would have played the break right here of these stacked imbalances, you could have put your stop right above those stacked imbalances. So in that example, you had the potential to make 14 points, only risking 2.5 points on that particular trade. Now, that's what makes order flow so powerful, is that you can get pinpoint entries into the market. Now, ultimately, the market did go all the way down, and look, at the bottom of the consolidation, which I'll show you guys in a moment on the 30-minute chart, notice what we get right down here. We start to get a series of imbalances. If that number 3 would have been a stacked imbalance, then we got back above it, we could have looked to play the move right back up. But for me, I probably would have passed, only because this was not consecutive imbalances. There was a gap in between those imbalances.